All right, so moving on to sales of business property. So the capital, we had that big long list of all the different factors that play into how we treat capital gains. We have a shorter list here. So how we treat it is going to depend on whether it was sold at a gain or a loss. Losses are restricted on the sales of these. If it's a gain, whether the asset was depreciated, whether it was depreciable, because it's allowed or allowable depreciation, whether the asset was depreciable real property or depreciable personal property. So we already talked about what happens with that real property and that depreciation recapture, how we have to separate out the depreciation portion from the appreciation portion. As with capital assets, gains and losses from the sale of 1231 assets also have to be netted. So we've got, and remember, the 1231 assets are long-term, depreciable or non-depreciable, so land, property used in a business, okay? So the ordinary assets are short-term, these are long-term, so one owned for over a year. All right, so we're gonna net these. So if a 1231 gain results, when you've combined everything, the net gain is taxed as a long-term capital gain subject to that depreciation recapture. The example that I started out with today. So it's a long-term capital gain and I think it's, so depreciation recapture. Okay. So net 1231 gains do receive the preferential tax rate treatment. If a 1231 loss results, the loss is treated as ordinary. So 1231 loss, ordinary loss. It is unlimited. There's no $3,000 limit. This is awesome. This is the best of both worlds. Because the 1231 gain, if you have a gain, except for that depreciation portion, if you have a gain, you get the lower tax rate. If you have a loss, you get to offset gains from ordinary tax rates, those higher tax rates. So this is the best of both worlds in this scenario. Ordinary loss treatment allows unlimited loss deduction. There's no $3,000 limit in this case. So we report everything on the form 4797. Here's an example. Yen sold land, so land is 1231 property. It wasn't depreciated because it's land, so we wouldn't have any of that recapture. Sold it for $15,000. Had purchased it for $7,000, so it's long-term. $8,000 gain is a 1231 gain, goes on form 4797, which I'll show you here in a minute. The $8,000 gain would be netted with any other 1231 transaction. So if he also sold the building that was on the land, that would be a separate sale. You would separate out the two because the land wasn't depreciated, but the building was depreciated. So you'd separate those two out, but you get to net those together. The gain is then transferred to Schedule D as a long-term capital gain. If it results in a loss, the loss is transferred to line 4 of Schedule 1 as an ordinary loss. So it's gonna, it would show up there and offset other, income on the tax return. So kind of a hopefully helpful little chart. Sale of a 1231 asset can result either in a loss or a gain. If it's a loss, you get to offset any other income you have on your tax return. If you have you have a loss of $15,000 and you have wages of $50,000, you get to use that $15,000 loss to offset your wages. So now your wages, your taxable income is $35,000. That's awesome, right? Because those wages are being taxed probably at a higher tax rate. If it's a gain, there are 3 types of gains. So if it was land, this would probably be land because it's the only thing that wouldn't have been depreciated. A 1231 gain, that's going to show up on that's going to show up on the Schedule D. 1250 recapture, this is depreciable real property. So real estate would be a 1250. 1245, this is any other personal property. We're going to go through the 1245, similar to the 1250. Okay, the 1250 is what we did earlier with the depreciation recapture, that we had to separate out the depreciation portion of the gain from the appreciation portion of the gain. Okay, let's see here. Here's the recapture. So depreciation recapture, depreciation is income tax deduction that obviously you offsetted ordinary income. So when you took that, when the taxpayer sells 1231 property for a gain, the gain can qualify for capital gain tax preference. Position of the IRS is if the taxpayer was allowed to reduce taxable income by taking a depreciation deduction and paid less in taxes when the property is sold, some of that gain attributable to depreciation deductions is taxed at regular rates. This is the depreciation recapture. So again, because when you took the depreciation deduction, it offset ordinary income. It offset the higher tax rates. So when we have to separate it out, and you're not going to get, if you have a gain, you're not going to then also turn around and get preferential tax rates. You gotta pay on one end and get the benefit on the other. Always with tax, there's always that balance between well, not always, but 99% of the time, there's always that balance. If you're going to get a benefit on one end, you're going to pay on the other end. The opposite is true as well. If you're going to pay on one end, you're going to get a benefit on the other end. So the theory is to transform as ordinary income the portion of the gain that was created by taking a deduction for depreciation because it had offset ordinary income. Personal property is called 1245 property, used in a business. Gain attributable to depreciation is taxed as ordinary income, whereas the gain attributable to depreciation is 1250, is taxed at a special rate of 25%. So the gain for and very rarely do you actually have gains on 1245 property. If you think about it, 1245 property is stuff like equipment, vehicles, furniture, computers. That stuff doesn't appreciate in value because you use it. It depreciates in value. So chances are you're not going to really have any appreciation of that, right? So for personal property used in a business, the gain attributable to depreciation is taxed as ordinary income, whereas the gain attributable to depreciation is taxed for real property is taxed at a special rate of 25%. So the difference between those two, remember we separated out the depreciation portion and the appreciation portion. The depreciation portion in that example I gave you to start out the class was taxed at 25%. For the 1245 property, if it's personal property, as opposed to personal use property is just stuff you hold yourself. You personally use it. Personal property is anything other than real property that's used in a business. If it's personal property, it's not going to be taxed, the depreciation portion is not going to be taxed at 25%. It's going to be taxed at whatever your ordinary tax rate is. So if you're in the 37% tax bracket, that's what it's going to be taxed at. If you're in the 15% tax bracket, that's what it's going to be taxed at. So that's one difference, even though it works the same as far as figuring out how much is depreciation, how much is appreciation, but the tax rate that that depreciation recapture is subject to is different, okay? So note that when a 1231 asset is sold at a loss, the loss is always treated as an ordinary loss provided there's no 1231 gains to offset the loss. So here's, let's see, the chart above. Oh, is that the chart that we just looked at? Oh, yeah, never mind. So 1245, this is personal property. Property is personal trade or business property, equipment, furnishings, computer peripherals, all that kind of stuff. Most assets that are used in a trader business, with the exception of real property. Land, buildings, building structures, and components are not 1245. That is 1250 property. Okay. So machinery and equipment used in a business, the 1245 definition also includes assets like automobiles, livestock, certain buildings placed in service between 1981 and 1986. Chances are by this time they're fully depreciated anyway. Well, I guess you'd have that depreciation recapture, though, that you have to deal with. 1245 recapture, any gain recognized is ordinary to the extent of the depreciation taken. 99% of the time, all of the gain is going to be due to depreciation, right? They don't appreciate in value. So here, we've got a taxpayer purchased a truck to be used 100% in their business, 5-year property. They use it for, they purchased it for $10,000. So there's their basis. They took depreciation of $61.60. Their adjusted basis is $38.40. All right. They sold it for $7,000. There's no appreciation. They sold it for less than what they bought it for, right? You can tell that. Minus the adjusted basis, here's their realized gain, $31.60. That is all going to be taxed at ordinary tax rates. Even though they owned it for more than a year, it's going to be taxed at ordinary tax rates because that depreciation deduction, they got a deduction at ordinary tax rates. So now the gain is going to be taxed at ordinary tax rates. Essentially, that's the recapture of depreciation they had taken, right? Gain is treated as ordinary, is the lesser of the depreciation taken or the realized gain. Well, that's the $31.60. So in practice, and I've already said this, in practice, a 1231 gain, any amount in excess of depreciation is rare because these are assets that only depreciate. They really don't appreciate in value. Let's see. We've got, time is it? 2:05. We could go through this. So we've got Noor, purchased equipment costing $12,000. Depreciation deducted on the equipment was $7,392. So the adjusted basis, these are 3 different scenarios here of what would happen. So the adjusted basis, same here. So amount realized, $13,000. Bought it for $12,000. So we know that it's appreciated by $1,000. So capital gain, at the capital gain rate, the 1231 amount is going to be $1,000. They're going to get that, whatever that long-term capital gain rate is. The remaining amount of gain, the $73.92, is going to be subject to the recapture because that was due to depreciation, right? In the second scenario, they sold it for $9,000. Well, they bought it for $12,000, which means they had it depreciated by $3,000, right? They bought it for $12,000, sold it for $9,000, depreciated by $3,000. That means that none of the gain that they recognized, even though they recognized a small gain, $43.92, it was all because it was depreciated property, not because it gained in value. So all of it's going to be 1245 recapture. Now we've got a third situation where they actually had a loss on the property. So they sold it for $4,000. The basis was $46.08. All of that loss, that $608 loss, is going to be treated as a ordinary loss. So they get it gets to offset ordinary income, or it's going to offset other 1231 gains. Okay, so again, this will be at capital gains tax rates. That gain, the 1231 gain, we've got best of both worlds. The gain, long-term capital gains rates. Loss, we get to offset other ordinary income. Well, we're going to offset first any other 1231 gains, but if we have any remaining, we're going to offset other ordinary income from that. Let's see. This is just going through everything that I just... I don't need to... So this has to do with, there are some QBI adjustments to it that we're not really going to get into. We don't need to do anything, but there is, it can, the 1245 ordinary gain can affect the QBI calculation, but don't worry about that. I know you still have PTSD regarding the QBI calculation, so I'm not going to subject you to that. Let's see. So this is just kind of how it would be. So how it would affect the QBI calculation. So you take your income from Schedule C. Remember, you've got to subtract the 1/2 of your SE tax, and that's where we kind of stopped in our calculation. But you also, if you have any 1245 recapture, you've got to add that in as though it was income from the Schedule C. So that's how that would calculate it. You actually would get a greater QBI by using this, because that increases the amount that can be applied to the QBI. 1250, we already talked about this. This is just the depreciable real property. So we did that calculation earlier, so I'm not going to talk too much about that, but just know, so 1245, I'm sorry, 1245. Section 1245, we're talking about recapture, and it pertains to personal property used in a business. And with 1250, we're talking about the recapture. My handwriting. And again, that's depreciation recapture of real property used in a business. Okay. Both of these also fall under section 1231 property. Okay, so those are just kind of subsections of 1231. And it only pertains if there's a gain, right? If there's a loss, then it doesn't pertain to that. It doesn't, that recapture provision doesn't come into play. So here's the 4797. Let's see, what example are they using here? So gain of $1,000, where's this coming from? Oh, so this is the first scenario. So if there was a gain, so 1231 gain, there you can see the first section here, sales or exchanges of property used in a trade or business. Most property held for more than 1 year. So our gain of $1,000 listed there. Let's see. I don't know why we're not listing. I don't know why we're not itemizing that out. Sales or exchange. I guess we don't have to. If I looked at the instructions, it would probably tell me why we're not listing that out. So that $1,000, and then let's see, this gain from 31. It'd be nice if they. Here we go. You got to do page 2 before you can do page 1. It's great. So this is a piece of equipment. Sold it for $13,000. This is where there's a gain. Sold it for $13,000. Cost us $12,000. We took depreciation of $73.92. So doing that calculation, subtract 22 from 21, we get $46.08. This is our adjusted basis. Our total gain, $83.92. If it's section 1245 property, in this case it's a piece of equipment, so it's section 1245 property. If it was section 1250 property, we would enter the information down here. But it's section 1245, depreciation allowed or allowable. So even if you didn't depreciate it, you have to treat it as though you did depreciate it. So that's where you might as well take the depreciation. So $73.92, and then enter the smaller of these two. Come down here. So total gains for all properties, add columns A through D, line 24. Here's our line 24, there's our gain. So this is where it would all be combined for different pieces of equipment or different types of property. Add property, columns A through D, lines 25 through 29. So here's the depreciation, 7392. Subtract 31 from 30, 1,000, and then enter it on form 4797. This is where it comes from, line 6. So that gets transferred over to page 1. Pops in right there. So here, this was gain, if any, from line 31 of 7392. So line 31 here goes there. So then it tells you where this goes. So enter here and on Schedule 1, Form 1040, Part 1, Line 4. So there's some income, and then this one as well. Let's see. Combine lines 2. Okay, so this, I'm trying to remember. So that's our, there's the 1,000. And on appropriate line as follows. So subtract line 8 from line 7. If line 9 is 0, enter the gain. If line 9 is more than 0, enter the amount from line 8 on line 12 and enter the gain from line 9 as a long term. I think that 1,000 should be here as well, because this is a long-term capital gain. Subtract line 8 from line 7, okay? This is 0, that's 1,000, so line 9 is 1,000. They should have 1,000 here as well, because that then should go onto the Schedule D as a long-term capital gain. So that should get transferred onto the Schedule D. Because there are two parts to this gain. There's the depreciation portion, and then there's the long-term capital gain portion. They failed to put the $1,000 on that 4797. So FYI, that should go there. All right. Buildings are called properties are considered. So this is just something that's not really in effect anymore. Let's see. This is just an illustration. Again. So building 200,000, less depreciation, adjusted basis, selling price. So here's our gain, the amount of gain we realized. So that minus the depreciation is going to be the appreciated portion. You can also get that by knowing that we paid of 200,000, we got 275,000. So this is how the two are divided out. This 75,000 is taxed as a capital gain. That's the 1231 long-term capital gain, and then this depreciation portion is going to be taxed as ordinary income. Let's see. What else? I don't think I'm going to go through this because we're running short on time. Okay, so that's the sale of business property. Keeping in mind the importance of separating out, if it's a gain, if it's a loss, it doesn't matter. If it's a gain, then we've got the depreciation that we have to recapture, and that's going to be taxed at a separate ordinary tax rate. Any amount of appreciation is going to be taxed at those long-term capital gains tax rates. Questions?